Hello there. My name's Daniel Lader, founder of Lader CPA and Associates, and welcome back to our Instagram Live series where we are talking about building a successful private practice from beginning to infinity. I overheard a therapist and an accountant talking, and the therapist said, "There's childhood trauma." The accountant said, "There's carryover losses." I said loudly, "Are we still talking about me?" So, the topic this week that we're going to be talking about is retirement plans and setting them up for you and your team. Now, there's three main kinds we're going to be talking about. The three big guys: the SEP IRA, a simple IRA, the solo 401k. Now, there's a lot more varieties of retirement accounts out there, but these are the big three. Now, first off, why should you care about a retirement plan? There's a bunch of reasons. First off, you're saving for retirement and you're reducing your taxable income. Also, it's a great tool for either a solo practice owner or a small business to attract and retain good employees. Also, there's a lot more flexibility in how much can be contributed into a business retirement account versus your own personal IRA account. Sometimes the contribution amounts are tenfold greater through a business instead of done personally. Also, I want you to ask yourself, do you want to be paying the IRS or would you rather pay your future self instead? That's the gist of why a retirement account is important. Now, I want to talk a little bit about using an advisor. Retirement plans have complicated setup rules, contribution limits, and different tax implications. So so you'll want to work with a certified financial planner or a CPA or both to choose the right plan for your business to make sure it's set up and maintained properly to maximize your contributions each year without triggering compliance issues. Now, getting it wrong can be very costly. So having an advisor help you from the start is a huge benefit. So let's talk about the three big retirement accounts. Let you know what they are in simple terms, on high level terms, so that you can make a better decision on what's best for your practice. First, most common and easiest is the SEP IRA, the Simplified Employee Pension Plan. So this one is great for solo practitioners or businesses with just a few employees. The contribution limit, it's 25% of compensation or $70,000, whichever is less. So that means you could, in theory, contribute up to $70,000 into any one person's personal retirement plan. Now, this is an employer-only funded plan. That means your employees, yourself or your own employees, they won't make contributions into this plan. It's all paid for by the company, the entire amount. Now, these are easy to set up and they have very low administrative requirements. They also allow you flexibility in how much is contributed into the SEP in total. Now, there is some requirements about how that total contribution is split between eligible employees. Let's talk about that in a quick example. Let's say you have $100,000 that you can contribute into the SEP IRA plan. You've got 3 employees, each at a different compensation level. Just randomly, let's say this one earns $70,000, $50,000, and $30,000 a year. What that means is of that $100,000 you want to put into the SEP plan, it is split according to each of those employees based on their percentage of compensation. Now, no employee can get more than 25% of the compensation. It's maxed out there. So those are some limits you have to keep in mind. But beyond that, you can contribute however much you want each year. You can contribute $100,000 in one year. You can contribute $1,000 in another year if you want to. But those are the basic rules of the SEP. And so SEPs are the simplest and most easy to administer. If you're just starting out and not anticipating a lot of growth, an SEP might be a fantastic option for retirement plans. The second big one we want to talk about, the simple IRA, the savings incentive match plan for employees. This is a little bit different. The main difference between the simple IRA and the SEP IRA, well, there's two differences. The main ones is, first, the employee is now responsible to contribute into their retirement plan. So they'll start reducing their own paychecks to contribute into the plan. The amount they can contribute for a total year is $16,500. These are 2025 numbers. Plus, if they're over 50 years old, they can add another $3,500, totaling $20,000 for the year. Now, that's the employee's contribution. The employer match is one of two. It's either 3% of the total the employee contributes, or it's 2% of the employee's total compensation. So one of those two. That's the employee's required match. Now, the total that can be contributed into these, like I said before, for the employee, it's $16,500 for 2025 numbers, with an additional $3,500 if they're over 50 as a catch-up contribution. Now, the simple IRA is less flexible than a 401k is, but it's usually easier to administer, so your costs are lower there. There is a deadline to set this plan up for the year, October 1st of the year you want the plan to take effect. You must set it up before that time. The third plan, the third big one I want to talk about, is the solo 401k. Now, the solo 401k, this is a plan for a truly solo practice. There will be one owner, and the owner will be the only employee. There will not be other employees. We can include a spouse as an employee if you want to, but there won't be other employees. So this is a solo retirement plan. The owner will fill the owner will fill two roles, the employee role and the employer role when we're making contributions. As the employee, they can contribute $23,500 every year. That's 2025's numbers. Plus, if they're over 50 years old, they can make an additional catch-up contribution of $7,500. That totals $31,000 of employee contributions. That's reducing their income. That's reducing their paycheck. Those pre-tax deductions. The other side of it, the employer side of it, they can share or they can contribute up to 25% of their own contributions into the plan. I know that's a little complicated, so let's just give you the top number of it all. The total maximum that can be contributed into a solo 401k, both employee and employer parts, the total that can be contributed is $70,000 for 2025. And if you're over 50 years old, another $7,500. So the maximum is $77,500 if you're over 50 years old. Now, the solo 401k is the best option for mental health practitioners who have bringing in a high income, have no employees, and want to contribute a whole lot into their future retirement account. So those are the three big ones. They all have different costs and benefits, but one thing that they all share is their tax deductibility. This is how we really use these as a tax strategy. Contributions into a retirement plan are almost always tax deductible. I'll talk about the exception in a moment, but they're almost always tax deductible, meaning all that income, all of those funds you put into the retirement account. If you're a solo 401k putting $77,500 in, or an SEP maxing it out at $70,000, or a simple IRA maxing out your significantly lower but still significant amount into retirement, all of that is tax deductible, reducing your own taxable income. It reduces, depending on the plan you're using, it either reduces only in the business taxable income or your personal taxable income too. But that's why we're making contributions into our retirement accounts. Pay less to Uncle Sam, pay more to future you. I guarantee future you would appreciate it a whole lot more than Uncle Sam does. So, when it comes to choosing the right plan, that's where we have to consider what your goals are, where you envision your practice being in a few years. If, like I said, if you want to be the solo person, no employees, just you, for 3 years, 5 years, 10 years, maybe the solo 401k is best for you. If you're staying small and just want it simple and easy, maybe the SEP is best for you. Maybe if you want to expand and get a little bit bigger than just the 2 or 3 therapists working under you, and you want to get a little bigger, maybe the simple IRA is best for you. It's all up to looking into what is going to be best for your situation in years down the road. Retirement planning is a years down the road activity. So go ahead and talk with your financial advisor, your CPA, your certified financial planner. They need to be involved in these decisions and helping you get these set up properly. You don't want these set up incorrectly and then later find out down the road it was done wrong and you've got to fix it now. So if you have any questions about this topic, feel free to comment below, send me a DM. I'm happy to answer any questions as I'm able to. Now, if you would like to schedule a free 30-minute discovery call with my firm where we can talk about your practice's tax strategies, go ahead and DM me. We'll send you a calendar link for a free discovery call. Go ahead and follow and subscribe for any future notifications about events like this or tax tips we give out, and visit our website, latercpa.com. I'll see you all on the next video. Have a great weekend and keep helping others to help themselves. Bye-bye.